In the life sciences space, I would say for big strategics, they're still active. There's an imperative for them to do deals as they're coming towards patent cliffs. A number of the big pharmas have big patent cliffs on the horizon, so they always have to bolster their pipeline, and they're active on bulking up that pipeline with biotech acquisitions. There's still value misalignment between sellers and buyers, but I think they're using more innovative ways to bridge and hedge the risk on pricing. On the PE side, there's definitely been a pivot away from pure pharma, so less OTC, less generic platforms, less specialty pharma platforms, and they're taking one step. They're essentially one step removed from pure pharma, and they're pivoting to pharma services a lot more. We saw last year big exits for Pharma to Mid-Europa, which we handled at Reed Smith. Another Reed Smith deal was the exit of Fair Journey to Partners Group, and that's the CRO. So pharma services is strong, and I think will remain strong in the PE space, but also clinical services as well. PE are moving towards clinical services as well, where I think there's a perception that they'll be less exposed to some of the pricing pressures that pharma are currently experiencing. I think it's fair to say that deal volume hasn't been where investment professionals would like it to be over the last few years. I mean, the macroeconomic factors coming out of the end of COVID in terms of the high cost of credit, pressure on early stage innovation, investment, pressure on valuations, those are still enduring right through to 2025, and that's had a noticeable effect on transaction activity. There's also a misalignment between pricing between sellers and buyers as well, and that endures. Sellers haven't really noticeably dropped their pricing expectations in reaction to the market, so valuations still remain broadly the same. And I think the factors that have allowed deals to happen are twofold. One, there's plenty of dry powder in the market still. There's money to be deployed, and to bridge the valuation gaps, I think buyers in a less competitive market have more scope to be a bit more innovative with the way they structure deals. So you're seeing a lot more earnouts, a lot more milestones to bridge the valuation gaps and the risks in future performance. And then to combat the higher cost of credit, you're seeing a lot more seller financing and equity heavy deals, which is far more prominent now than it might have been pre-2022, when a lot more of pricing was bundled into upfront cash. Now a lot of the pricing is kind of back-ended in deals, and that's where we're seeing kind of structuring going in deals to kind of alleviate some of the challenges that investors are facing in the market.